Cool. Great. And with that, I welcome the PM to open the debate. Here.
Is everyone ready? Can I just get like an okay from you? Great. Oh, and then POIs in chat clarifications can be done verbally. If I don't take you at 5, you can also do POIs verbally. Great. First on the burden, then many arguments. This isn't a debate about whether traders should only use AI, not even a debate about whether it's bad if it is the dominant form of trading. This is obviously a tool in the toolbox that traders can use to supplement other analysis, likely the kind of analysis they've spent the past 25, 30 years learning. 2, many traders are either skeptical of AI or don't have access to it. So importantly, there are competitive incentives to differentiate their strategies because you need comparative advantage in your strategy. I.e., if everyone else is using AI, then presumably there's an incentive for me to not use it because there's probably something that they are overlooking. There's a equilibrium that is reached here. Couple of arguments. First, this is good for investors. Why does this matter? I want to be clear. This isn't a debate about the uber wealthy extracting value by using AI. The vast majority of people have money in their retirement funds that's tied up in equities, and there's 2 reasons that what traders do with AI matters to them. Either the prices of those equities are affected by the perceptions of traders on the value of those equities, or 2, they are in actively managed funds that directly use the AI to decide what to buy or sell. Secondarily, pensions are also likely to use these tools to supplement their analysis. These pensions are oftentimes tied up in the formal economy for every government service worker's retirement in any country with a welfare state. 3, countries with sovereign wealth funds like Malaysia, China, and Norway that have the ability to also invest in equities in the formal economy also times use the value that they get from those funds to fund specific projects, to supplement things like businesses, to do things like build infrastructure, and importantly, things like globalization and securitization mean this is the 4th thing, that these wealth funds and economies are broadly interlinked. So who are the traders that this round is about? I want to be very clear that this debate is predominantly about funds. It's not about my mom not having access to AI for 2 reasons. 1, most people aren't doing the individual stock picking themselves. It just takes too much time. You know you are unlikely to beat the market. You don't have the info. It's just way easier to put it in a fund. But 2, just on a question of scale of impact, even if my mom doesn't have access to this AI and loses out to some other trader, presumably the kinds of things that what happens when a trader is able to price or misprice an equity and do like a really bad trade because they missed out on something that AI would have caught is presumably way more overreaching in terms of scale. But to the extent that it is about individual people and not funds, we would say that AI is likely a democratizing process because the counterfactual is them always getting beaten out by the market. If my mom is going to be on Robinhood on either side of the house, she's going to buy stocks because she's like, oh, I've heard of Nike, and then lose money. Presumably the access to AI replaces the fact that she doesn't have an MBA, and if it is better, which we'll explain later, probably means that she has access to a much cheaper service that has a better idea of telling her what to do. It'll probably be integrated into the brokerage and things like this to help her make comparatively better decisions. And obviously we can have different AIs tailored to different strategies. So if you were just my mom on Robinhood, presumably it won't be requesting really risky stuff because the way that it will be developed for brokerages for someone like my mom is obviously going to be suggesting different strategies because it will take into account things like her profile and things like risk. So the comparative. What does trading look like in the status quo and what are its problems? There's 2 things here. First, trading oftentimes looks like things like fundamental analysis. They look at things like the balance sheet. They look at things like organizational culture. They look at things that it's very like traditional, like, oh, I did my own research on the news. The problem with this is that oftentimes you don't have access to the wealth of information out there that AI is able to look at because you only have so much time in the day. Moreover, you are also open to things like human bias, things like psychological biases against what good organizational culture looks like if you're particularly sexist or racist and think, oh, these traders are probably, clarification.
Yeah, so just to be clear, these AIs rely on like patterns and data, right? So the research and theory stuff is more on up, even though you say they're complementing each other, yeah?
Yeah. So presumably the counterfactual where you would do more of that research. Our argument is you can supplement that and say, oh, I did my own research, but AI did something different. Presumably you'll find out why. Secondly, you could look at things like technical analysis. This is looking at quantitative indicators, like trying to read the tea leaves of what happens when the line goes up or down. But importantly, there's so many quantitative indicators to look at that it's still open to human error because technical analysis still relies on you deciding what quantitative factors matter more or less to you. Why is AI a particularly useful tool here? One, it is able to process data more accurately and just way faster than humans. Two, it's able to remove bias from decision-making, biases in fundamental investing, where traders look at things like organizational culture. Three, it's able to synthesize multiple types of analyses better. That is, it's not just a black box. Presumably, AIs can be customized in different people to the extent that they just want to amplify the strategy that they're doing, can just use AI to look at these things for me. So if, for example, I want to look at things like the fund flows for this thing relative to all of its competitors, AI can just make that a lot quicker because it can look at all of those considerably faster than it would take me to pour through this on my own, or make my analysts do it for me, hire Bain to do it, all of these things. So importantly, I think we prove AI is probably better than the comparative, but I note that that isn't even our burden. Our argument is just that it considers other factors that current traders don't. That is, even if op proves to you that there are blind spots that AI overlooks, those blind spots are different from current trading strategies, and current trading strategies cover AI's blind spots. And importantly, as I pointed out in the framing, there's a competitive incentive for different people to call out other people's strategies for not working. Moreover, I think it is likely the case that there will be a degree of research into this AI that makes it such that we kind of know the what's inside the black box here. So it's just like a diversification of strategies is better for the market as a whole. How is this AI likely to be used? Two things. One, it probably won't be reckless or immediate. What this proliferation looks like is not just going to be like, oh, everyone's doing AI. Op is going to say things like first mover advantage. But when you're playing with millions of dollars and your reputation on the line, and there are strategies you are already familiar with, you obviously won't be quick to do something you don't trust and just abandon your current strategies. You'll likely supplement them, or to the extent that it disagrees with your current strategies, you'll just consider different data. But two, I think it adds stability to unstable but sexified markets like cryptocurrency. Rather than investing in Dogecoin, you have skin in the game by being a part of it, and investing in an AI managed crypto fund. I know that efficient markets is like a broad term that people don't care about, but what does market inefficiency mean for the real world? Market inefficiency is when a few traders, like in 2008, could see what was happening to home prices, but the vast majority of people were blind to it because of the confirmation bias that, oh, my strategies are working. Our argument is that AI is comparatively more likely to be like, wait a minute, credit default swaps are really going up. Maybe something is funky with the housing market, and more people will be alerted to that, right? What mispricing looks like when the market is inefficient means that it is considerably more volatile, that you thought you had $1,000 at Amazon, and then oops, actually the market was inefficient. The true price of that was $200 because there was more data that wasn't taken into account. Our argument is that over the long term and from the day to day, AI will make it such that the market is considerably more stable because it is likely the case that it is taking more information to account. So there isn't going to be just broad mispricing due to broad groupthink. Secondarily, bubbles are just bad when there is demand that is not aligned to the truth due to things like mob mentality over things like GameStop. Third, I think it is likely the case that there'll be less high frequency trading because at the point where the market is more efficient, the way that high frequency trading works is such that it tries to find those inefficiencies and just make money off of them by doing small little trades. That is often what a lot of people are doing on their side of the house. We reallocate that capital, those smart people, those lovely people who graduated from Princeton, to do shit that isn't high frequency trading and are able to do other things to the extent that AI is broadly scalable and you don't need to have a bunch of analysts work on it. For all of these reasons, incredibly proud to propose.
I thank the PM for that fine speech, and now welcome the LO.
So we think this is going to create bubbles. I mean, those bubbles are going to burst. I'm going to get to that. But first, I want to do a brief response to opening government on the idea of biases in these industries. I think historically this might have been the case, but I think post 2008, a lot of these things began to to be moved away from, insofar as companies were moving towards people who had better track records of solid investments and those kinds of things. I also don't think that they proved that a lot of the kinds of biases they talk about, like looking at company structures and looking at reading the news and that kind of thing, are actually bad, as I'll explain in my extension. So the first thing I want to clarify is why AI is oftentimes bad at making these kinds of decisions. Firstly, I think it's a reliance on historical data, i.e. it relies on trends and emergent patterns, which it can oftentimes interpret through the lens, or it interprets all things through this particular kind of lens. Now, OG agrees with this. Like, OG are agreeing that they don't read the New York Times and make predictions off of that. That's a different kind of AI. Specifically, these AIs are looking at patterns and trends. The harm of this is there's oftentimes emergence of new scenarios and possibilities that these things don't have the framework to consider. So if, for example, something happens in the news one day, an AI trading platform is not going to be able to consider the effect that might have on a pattern. Oftentimes those things like political or geographic phenomena can change these things massively. Secondly, there's biases and lacunae in the data. So for example, if you only have one study available on copper mining in a particular country, and that's the only study off of which you can make predictions into the future. And if you can't check, or even if you're doing things like reading studies, or there's only very limited data available in the economics of a particular area, very low quality patterns that you can deduce, oftentimes those things are going to be extremely limited. Thirdly, also there's just not a lot of data available in a lot of things. Thirdly, they also don't know which data to pick, which is to say, like, you need to have a framework of identification of which kind of information to check as being important, which patterns to consider. So in their housing bubble example, they haven't proved that the AI will be checking things like credit default rates and that kind of thing, because they don't know whether those things will be relevant to the decision in the first place. Why is it mutually exclusive with human traders to some degree? Firstly, AI is a significant cost-cutting measure for a lot of industries because you only need to buy the proprietary AI once, and suddenly all of the low-scale traders that opening government talk about get gotten rid of or reallocated to different things within the company. So that's oftentimes going to be very profitable for these companies who are competing on price. Secondly, the cult of AI. I think OG around the people are skeptical about AI. I think as we've seen with the emergence of loads of people buying into cryptocurrencies, and even after the crash, oftentimes identifying cryptocurrency is not the problem itself, but as AI is the solution moving forward towards these kinds of things as being beneficial, which is to say we believe it to be objective, we believe it to be the future, and particularly people in hype-based industries are likely to cut into this. Thirdly, I think it increases the scale of trades possible. So you can make thousands and thousands and thousands of trades with an AI, with an artificial intelligence algorithm that you can't make with a human trader. So even if you have like one AI and one dude, that one dude is making fewer trades than the artificial intelligence is. So the share of the market that it's covering is massively high. I also just think it's seen as objective in general. The comparative here is three things. Firstly, 2008 worries led to a lot of people wanting to engage in more theory and identification of emergent trends through non-pattern recognition means, because they saw the harms of pattern recognition in those things. Also, the dot-com bubble partially played into that as well. It means more theory, more investigation, more predictions based off of geographical and political and sociological phenomena as they emerge, and being a little bit wary about engaging these kinds of things. Thirdly, I think it also means, secondly, I think it means more differences and diversification in the market, which is to say humans are going to have different ideas about different things, won't put all their eggs in one basket as frequently as the AI will, because the AI necessarily are going to be quite similar in terms of how they identify patterns and trends, even if they're tools differently to predict those kinds of things. Before I move on to the bubbles, I'll take closing.
The info set stipulates machine learning, so the capacity to be predictive and evolve outside initial fat data is there. What exactly is the impact, even if it's archaic data?
So machine learning is necessarily going to be based off the information you have at the start and how that information plays off in the future, which I'll explain later. But that doesn't give you fiat to say that they get particular kinds of information. You have to rely on patterns and trends in the market as per the info side. So bubbles. The information I've just given you is why they're oftentimes going to misidentify trends in a particular area. So say, for example, they might think that copper is going to be the next big thing because I've seen a slight increase in the copper market or in commodities trading. Oftentimes these things are going to be self-fulfilling prophecies, because if lots of different AIs buy up shares in a copper company in a particular country very quickly, that will increase the price of those shares, right? Or give that company more funding to be able to invest and buy things up in general. So the price of the shares increases because of the similarity between AIs here. And so you get short-term stable growth in those areas. And that's importantly the reason why you don't question it as per opening government or like in opening government's analysis, because you're not skeptical of it in the short and medium term as it leads to growth for you. And it also leads to things like complex derivatives happening on these trades, which infect the economy, right? It means it goes into lots of different areas of the economy very quickly. And it is a black box, which is to say, it's not that it's a black box in terms of we don't know why it's making decisions. We know that we asked it to get a particular rate of return and at a particular rate of risk. We don't know how it's making those decisions because we don't know what data it's drawing from and how it's interpreting that data itself. At a certain point, however, once these things become inflated and a lot higher, these bubbles are likely to burst, either because the price just gets too high and the new companies are not able to buy into it, or the capital drives up through to things like increased interest rates in the market or just otherwise economic downturns, or the endogenous product itself becomes shaky. So if you look at like the dot-com bubble, for example, there was just fewer people engaging with the internet as the growth predicted. Same with like, if you take the example of the copper mine we talked about earlier, it's just domestic political strife that you could have read about in the New York Times but chose not to, that oftentimes can lead to a destruction of these kinds of things. And when you try to sell off, the people who earn the market start selling off because the growth is slowing down, everyone sells off and the thing crashes. Now, on the small scale, this has particularly important impacts because even if this doesn't affect a significant amount of the economy as per opening government, it have massive localized effects in where it does take place. So, for example, maybe the big trading firms don't care about that copper mine, but maybe a particular country's industry is entirely reliant on their exporting of copper. And suddenly when all the money dries up and it goes away entirely, that start firing people. You get conflict within those countries. You get massive economic downturns within a particular localized either section of the economy or section of the world geographically. So these impacts can be pretty localized. And if this doesn't hurt the bottom line of the investment companies too much, then they keep doing this sort of process. They say, well, the AI got it wrong this time, it'll get it right the next time, if not realizing the massive deleterious effect it's had on them. But on the wider scale, if this thing does in fact integrate into a wider amount of the economy. Note the analysis I've given earlier suggests why this is going to be the case. That's when the harms come to opening government, right? That's when those pension funds start not being able to give returns for people. That's when like day traders that are doing these things lose their mortgages. That's when you see a lot of these significant negative things starting to happen on a wider scale in the context of the economy. How should you weigh this contribution to the debate? And in and of itself, the first part of the analysis I gave as to why AI is generally speaking going to be pretty bad in terms of its reliance on historical data and why the comparative is going to be a lot better is pretty significant. And also integrated with the analysis that comes later as to why there's going to be a degree of mutual exclusivity is necessary material for the opposition bench to stand. I also think the benefits that we can bring you, or so the harms that we bring you in terms of wide-scale destruction, either on localized or wider levels, is more important than the general stability in the economy that happens when you have more diversified humans engaged in these activities. Anyway, and so even if the risk is pretty low, the impact is pretty high, so I'm very proud to oppose.
Great. I thank the yellow for that fine speech, and now welcome the DPM.
Cool. Am I audible?
Yes.
Great. I'll take POIs in the chat. I want to start off with an observation about the opening opposition case. They tell you that people are not skeptical about AI, but then later in the speech tell us that it's a black box and we don't know how it's making decisions. I think this is symbolic of the problem with the opening opposition case, that one, it is internally inconsistent, but secondarily, that it is woefully non-comparative to what the alternative world looks like without the proliferation of AI trading models. I want to first clarify exactly how AI is going to use, because it seemed like Dylan did not listen to Dennis's speech. AI is able to ingest large amounts of information to synthesize various types of analysis. This means that you're able to ingest data from things like 10Ks to do a lot of technical or fundamental analysis. It means that you analyze live ratios for markets to make sure that you're using up-to-date data, but it also means that you're able to synthesize information to do things like sentiment analysis, which seem to go completely unanswered. Guys, it's not like AI can't read the news. Like, the entire way that ChatGPT was built using NLP is the exact same technology that's going to be going into a lot of these models. Like, we are just able to synthesize large amounts of information in a much more effective and efficient manner and create access to that for a larger group of people. That is, simply put, is the thesis of our case and what we actually offer access to. So clarifying how information is ingested, I think we're already ahead of the entire OO case. The second thing that I want to talk about, though, is specifically about how this is offered. Look, the criticism that we get from the leader of opposition is that, oh, there are specific ways that it's going to be done and we don't know exactly what's happening. And when all of the AI does the exact same thing, things are going to go fucking wild. Like, guys, this is not at all how it works. Like Dennis tells you, the incentives in the markets for various banks and various funds is to create differentiated AI strategies. So maybe certain AI will be overweight on emphasizing some certain factors, whereas other AI will be overweight on emphasizing others. Some AI might be more interested in ESG and other sorts of sustainable governance, whereas others are going to be focused maybe on like more natural resources. AI is not a one-size-fits-all solution. It is an approach to investing that allows you to create better decisions. So all their arguments about, oh, you're just going to have this AI like all buying the same thing and creating a bubble is really, really bad. But I want to say, like, let's say that you buy their analysis, that this fucking copper mine in the middle of nowhere is going to have all of the AI traders that like suddenly just buy it up. The counterfactual is that in the real world, people want to hop on the train because they're afraid that they missed out. So even when it is no longer efficient, they continue to buy so that they can be part of something, because that is the confirmation bias that traders act with. This is exactly what happened in 2008 and is going to be really critical later in the speech as well. But with AI, I want to note something. There is an inbuilt stop loss mechanism. That is, that trading is fully automated. So if AI prices the value of a share in this copper mine at, let's say, $100, the moment that it hits 100, AI stops buying it because it believes that it's accurately priced. Like, AI has a much better corrective mechanism than individual traders ever do. But secondarily, traders are expressly horrible at this, especially when it's other people's money at risk, because they never have to individually bear the risk. They're trading on on behalf of other people. And so they're like, oh, I can take a shot because worst case scenario, I'm not going to have to bear the risk. That kind of decision making gets cut out on our side of the house because you can actually make the decision attributable specifically to an AI that is going to be fundamentally more accountable. I want to respond to the black box argument. Like, just because you don't understand what AI does doesn't mean that there aren't scientists who really do. Because the main important thing about AI is that it is able to basically use a bunch of generative information to say, hey, here's a decision that you make. And if you don't like the exact output that you get, you can understand why it's made. Like when they built ChatGPT, you think like 10 nerds sat in a basement and were like, guys, we created a chatbot. We have no idea how it got here, but it works perfectly. No, it was extremely iterative and took them a lot of revisions, a lot of modifications for them to see, how is the probability-based model working? How can we tweak it? How can we make the network more effective? All of that scientific research has gone into refining these AI models. Like Dennis gives you this piece of analysis that is completely unrefuted, which is specifically that no trader or bank or fund is going to rely, one, entirely on AI because there's a little bit of uncertainty, right? There's not perfect information about everything that it can do, but they're not going to replace their business with AI. They're going to supplement it because they realize that there are things that AI can do that are better than the things that they do. I think after this, like opening opposition is woefully behind because what ends up happening is that we can synthesize all of the information that opening opposition cares about, but specifically on our side of the house, we're able to do it in a far more efficient way. I want to make another observation. The motion specifically is about the proliferation specifically of artificial intelligence trading models. Absent this proliferation, it stays localized in certain areas, meaning that the status quo that opening opposition and opposition bench as a whole is defending is a world where these models exist, but not one where they're accessible to every individual person. Right now, they are locked up behind the funds that only the extremely wealthy can actually access, meaning that they have a massive edge on the market. Like, unless closing opposition wants to enter the debate with a strand of argumentation that says retail investors are consistently beating hedge funds, I don't think that there is a tenable line for the opposition bench to stand on. Before I go further, I'll take a POI from closing.
Do you think necessarily the growth of the stock market correlates to the real growth of the economy?
Absolutely. The reason it does is because generally speaking, there's endogenous growth within the economy. Simple inputs include population growth driving demand up, meaning that there's greater demand for goods and services, causing the value of individual companies to grow. Overly simplistic example of 2 years of economics classes in college, but simply put, yes, generally speaking, the economy is a growing thing because there are more people it needs to service. We think that AI better identifies the areas of the economy that individuals can focus on and takes the burden of picking away from those individual people. I want to do comparative analysis that opposition bench has missed, which is in the status quo, individual people, whenever their money is tied up, whether it be in banks and index funds for a lot of people, retirement, pensions, they don't have access to the financial tools and active management that the super wealthy do, meaning that income inequality becomes even more striated, and these are the people that are hurt the worst when it comes to times of recession. What AI does is it levels that playing field because the best AI and even a mediocre AI is substantially better than the best active manager in the long run. It's going to be able to ingest information, remove the human element, and analyze every piece of information that an individual person would be able to, but do it much more faster, remove the emotional element, and is so much easier to scale and implement for all of these banks and funds that it actually makes it possible for the individual to not get fucked by the market. We're extremely proud to propose.
Great. I thank the DPM and welcome the DLO.
Right. Can you see and hear me?
Yes.
All right. Setting up my timer. I'll take POIs in the 5th minute. If I don't take it, kindly ask me via voice within the 5th minute. So. All right. I think there are three key things which opening governments misses for which we gain the debate, or three key mistakes. The very first thing is that they want to limit the specific impact or spread which AI is going to have, but they want to claim the benefits. Notice that these two are interlinked, which means that if we get the correct proliferation of AI in their world, then that is commensurate to the amount of benefits or impacts which you can get. So if you buy all of their arguments on how this would be used carefully, would not be used widely, then it means that you can't buy all of the specific benefits which they want. Then it means it shrinks in comparison to status quo with what we have. Because the proliferation should mean something. They don't explain it. Only Dylan does and shows you how it is going to be proliferated. Secondly, the profits also mean that more and more people are going to pile on. They are less willing to choose a diversification strategy if the massive returns which are happening on their side of the world is very, very high. And even if it is true that people diversify and people move away, if normal trading funds are making more money, it means that more people are going to go there and you do not get the benefits which they want. The second thing I would like to talk about is that comparative is not the quality of data. And I think this is very, very important. And notice clearly what the info slide says. It says that wherein a user does not have to intervene once certain conditions have been set for the AI to make a trade, and that this AI specifically makes this trade. This means that on the comparative, we still have access to AI to do data analysis, to put in all of the things which they want to talk about. The specific difference that exists is that do you allow the AI to make the autonomous decision, or you allow human beings to do this? The benefits which they want to claim on their side is that the AI is able to make those decisions better than humans, and that the AI is able to do it in a much, much faster way. So on our side, we're able to still co-opt all of the benefits of better investments and things like that. But we are also able to add all of the things Dylan tells you about the ability to make or create social propositions around it. What is going to be the other specific impact of this very decision that we are making? Our ability to be able to consider all of those different circumstances outside of the capacity of the AI. Also, our ability to be able to stop it, because I think this is very, very important. Given that you cannot stop it on their side of the house, the impacts are massive. And therefore, there are two things I'm going to do here. I'm going to show you the impacts Dylan shows to you in terms of the bubble being bursting, and I'll do more in being able to expand and show how it happens. But a couple of things I need to deal with. From their side of the house, they want to claim that this specific AI has the ability to learn everything at once and change and switch and do everything they can do. But I think clearly from what the motion shows, there are a specific set of data which they're supposed to rely on, which Dylan explains to you how that data is limited. They're also limited in the level of patterns in which they can have or have the ability to predict to. You also need to define the specific data, because even if it has the ability to pick up more data from the other side, your ability to know what is going to interpret it into or use that data for, it cannot be very, very clear to you at that similar moment. Therefore, even if we consider that the errors are less on their side, your ability not to stop this error, in the sense that when you set these conditions, it is non-stop. And the huge frequency of it means that the mistakes are amplified to a huge degree. Notice that on the comparative, we have the ability to stop immediately, and the frequency of it means that we are able to mobilize ourselves anytime there is a loss there. I also want to tackle their argument on the level playing field, because I don't think this is comparative, and I don't think this makes any sense either. Because bigger institutions still have the capacity to be able to invest more in this AI and to be able to have better versions of it, and are able to make way, way more trades than you. Therefore, and I think this also bends the extension that closing opposition wants to come with, to come and show inequality and stuff like that. Even if there's no AI in any part of the world, I think that these companies can still hire people from Harvard. I'll take a PR from closing governments before I go on.
Do you believe that the average trader is unbiased in calculating risk, or are they blinded by potential return?
Yeah, but I don't think that's the argument in today's debate. Like, even if this trader is biased and this trader makes a mistake, I showed you that the capacity of that mistake, and the extent to which it is able to go due to the frequencies, far lesser. Secondly, when a specific trader does it, you are more likely to be able to hold that person accountable, and you are more likely to stop it compared to this AI, which you cannot do anything about it. And notice that Dylan also explains to you why accountability measures continue to exist in status quo to be able to deal with some of these things. There are two things Dylan explains to you: that there will be a bubble, and that these bubbles will burst. I don't want opposing teams to come in and say, oh, this how likely are bubbles to burst and everything, because bubbles do burst within sectors of the economy. So Dylan tells you that sometimes it could just be sugarcane, and it might not mean a lot for you over here, because anytime you look in your Tesco shops and there are certain and there's tomato shortage or there's cucumber sausage shortage, it is not just the impact to your family, but then also the consequential impact on all people along the supply chain and train, and mostly the primary users who are the most vulnerable people. For example, people who are losing their farms and things getting rotten, etc. So it doesn't matter the size of the bubble, the impact is significant in this case. He proves to you that this becomes a self-fulfilling prophecy, gives you many mechanisms for why people are going to create complex trading derivatives on top of these things in order to sell. You have more market analysts influenced by this trend, which means that trend analysis, trend data in the past months are going to point in that particular direction, because notice that once these guys set on the trend, it is still likely to continue in that way, which means that people are likely to pile on this and be able to tell you and give you analysis that this is the future, which means that it is hyped in a way that everybody begins to pile on it and are able to have most of these impacts, right? So in essence, how you get this bubble bursting is once there's a significant price change in most of these instances, then we have a huge bubble bursting, which is able to bring all of the different impacts, and we're proud to oppose.
Great. I thank Teioh for that fine speech and welcome up the member of government. Here.
Hello. Can I check that I can both be seen and heard?
Yep.
Okay. Starting the speech in 3, 2, 1. What the opening half of this debate misses is that the democratization of financial markets is an inevitable trend. That is to say, the people are going to flock to GameStop anyway. The Reddit traders are going to make their dumb decisions on financial markets regardless. The difference in this debate then, which closing government is uniquely going to introduce, is about how we're going to prevent these stupid people from making the stupid decisions that destroy the economy through bubbles that opening opposition outlines. What closing government is uniquely going to push is that we don't care about the extra $20 that an individual might make. It is about the reduction of risk overall that healthily secures the economy in the long run and prevents all of the worst harms of opening opposition. The extensions are going to be integrated with all my rebuttal. Before that, I think I want to outline firstly the characterization of the decision-making mechanisms for AI or otherwise, which will, I think, quite quickly frame opening opposition out of the debate, given a vast majority of their analysis contingent upon a mechanistic contention that the AI is going to make bad decisions, or that the AI is built upon using insufficient or faulty human information and then passing it off as perfect outcomes. There's two things to note here, right? One is that if there's only one single study on copper mines, for instance, which is absolutely ridiculous for them to base their entire case on the fact that one industry has very limited information, then presumably the AI is going to tell you this is a risky investment, don't invest in here because we have limited information about it. The AI isn't going to make shit up and decide, you know what, I'm going to pass this off as truth, because the point of the AI and closing government is that it operates on truth and information, and when there's a lack of information, it will tell you there is no information, in which case a vast majority of the harms is boxed out. But secondly, their case also requires the decisions of human beings and AI to be vastly different, but the analysis that they push is never exclusive to AI. What does this look like? It means that absent of AI, the average individual will still be making the decisions that opening opposition says is harmful, i.e., how else do you think the average individual is making the decision? Of course, they're going to look at trends. Of course, they're still going to use the same imperfect information, which means that when there's imperfect information and when there's a vast amount of information to sort through, when there's a lot of trends for you to overcome, we posit that AI will always make the best decision because of the nature of AI versus like the human capacity. Humans don't have the kind of time, energy, intelligence, attention in order to have that perfect dissemination of information, which means that when opening opposition says AI won't look into these extra factors because it's unclear as to how things will factor into it, of course they will. That is literally the point of AI, to look into all of the other factors that the human mind doesn't have the energy or capacity to look into this. And AI, for instance, can account for demand for certain equities and goods and things like that. It can see when, for instance, a bubble is about to be formed, right? Opening opposition's push is that you can stop the error faster. Presumably, nobody knows that it is an error while they are making it, right? Nobody during the financial crisis before it happened was like, you know what, this is a bad decision, I'm going to keep making it. The difference is that AI would have known. AI would have tracked the trends, would have tracked the tiny discrepancies that human mind would have overlooked, and therefore we would not even have the financial crisis because we wouldn't have made these decisions. You never know something is an error until the economy has collapsed on opening opposition. On closing government, you see it coming beforehand, and the AI prevents the worst exodus of harm. How does this impact the average individual? We have three mechanisms to introduce. Firstly, on imperfect information. And here's where we're going to differ from opening government again, by saying that it is structurally impossible for opening government's mother, for instance, to overcome the lack of information. You're not economists, there's no jargon you can decipher, and you have no technical knowledge to understand for instance, opening opposition's research on copper mines. The difference is that people are always going to tout this as the very good way to make money, to make big money, and the average individual will always flock towards financial markets regardless. The difference is then whether or not we're able to give them the tools to succeed, and insofar as only rich people can have access to Oxford graduate economists, Wall Street journals, or whatever on opposition, closing government means that more people can access it, and therefore less stupid decisions are made. But secondly, the manipulative corporate narratives that opening opposition outlines, in fact, becomes even more predatory absent of these AI models. So if it is built on information alone, then it is going to be about information and nothing else. It is not going to be politicized. They're not going to tell people mortgages are good. They're not going to make people buy 15 houses for the fun of it, because AI is purely about what is the best decision for the individual. It means that corporates can't get away with, for instance, manipulating people into buying stocks that aren't beneficial for them. So presumably, if corporations are so malevolent as opening opposition claims, it is far better on closing government, in which case they cannot be like swindled by these corporations, and there's an objective thing to tell them, hey, listen to us, don't fall prey to whatever narratives corporations are pushing now. Lastly, about high risk appetite of individuals, I think you see how we once again for ourselves from opening government, because this is not about, for instance, people who are intelligent. This can just be for anyone in general. It's not about knowledge, about capacity. We think given that in the status quo, there is no objective opinion about what is the best economic decision to make, everybody has their own personality or propensity to overcome the kinds of different factors that they can never factor into. The AI is uniquely the only factor that's able to account for everything and come up with the most objective information. The proliferation of AI then makes it more accessible, makes it more developed. There's innovation that's put into the technology, and eventually we can reach an equilibrium where people agree that there are certain things that we shouldn't risk, things, for instance, that cause the financial bubble. How does this weigh against opening government then? They only want to engage with hedge funds and like Wall Street economists, i.e. people who are already the most knowledgeable in their fields. We also engage in the least knowledgeable individuals, for instance, who are more likely to flock towards the industries and make greater decisions, insofar as there's a far more number of individuals entering the industry now. But we also engage in knowledgeable individuals. With regards to the risk appetite, we attack the core of human error. They're too idealistic, they don't know what they're doing, and we get rid of all of that under closing government. Here's where we have real impacts of more than just equalizing the playing field. It is not about the person losing money, it is about millions of people flocking to the market and destroying the economy, opening opposition.
You can call our case ridiculous all you want, but the reality is that whether data is enough to invest, whether trends are real or fake, whether a political development endangers an investment, they're all things that a pattern recognition software is not equipped to deal with, and your opening admits that that's the comparative.
A problem with data, not a problem with AI. Presumably on your side, people would still be investing into these industries, in which case then you would still inherit the same harms. If there's going to be so little information, the AI will tell you don't invest in it because there's no information, in which case it is symmetric. The debate is about the mechanisms to understand the information that currently exists. And when it comes to understanding information, AI will always triumph. And AI will always triumph because it's more capable and because it's more accessible, which means everybody can have access to it. Lastly, then on industry-wide improvement in two ways. One, about reducing the risk of bubbles in the first place. So bubbles that opening opposition rightly characterizes comes from the average Reddit trader making millions of stupid decisions that ultimately culminate in a bubble. But they have to note that the stupid decisions are going to happen on either side of the house because people still want to engage in these trades. The difference is then who is able to prevent the people from engaging in these decisions, i.e. providing them with information, not allowing them to resort to groupthink that opening opposition seems to say is so harmful. But we think lastly as well, there's also a propensity for governments, for instance, to engage in these practices, investments into bonds, into economic risk. When the government is able to undertake investments into financial markets, we stabilize the economy, we prevent all of the bubbles and all of the harms to the tomato seller that opening opposition is really, really obsessed about.
Great. I thank the member of government for that fine speech, and now invite the member of opposition.
Oh God, I'm not visible. Give me a moment. I'm visible now, right?
Yes.
Okay. POI is only in the chat. Two extensions from closing opposition. First, where the gap between big investors and small investors becomes wider. And secondly, on innovation and where the human element is important in putting the money where the money needs to go. Firstly, on the gap. Note that AI models interact with other AI models. This is because you as an investor want to predict where other investors will put their money so that you can adjust your decisions in such a way that you can gain more money. For instance, if you know that a certain stock is going to go down and then go up again, you want to buy that stock when it's at its slowest. The problem, however, is that some AI models are much more advanced than others, and this is for a couple of reasons. Firstly, some AI models have access to more metadata because big companies have agreements with smaller companies and suppliers by which they can extract their internal business practices and they know more in depth how they work. But secondly, bigger AI models that cost more money have more hardware and therefore. And thirdly, more efficient learning methods are newer and they are patented, and only some companies have access to these, those that have invested into these patents or can buy them. The consequence of this is that advanced AI can outcompete less advanced AI quite easily. Intuition pump on this: when you have stockfish in chess fighting against weaker AI, it almost always wins because it can simply mathematically outmaneuver it. The problem with this, or the consequences of this, are threefold. Firstly, this engages with opening government and closing government on access. Because note, if you are a small retail investor, you can invest into a hedge fund anyway if you want stability. But OG doesn't prove that you as a small retail investor can now independently use your AI to make the best decisions. You can't do this because your AI is simply not as advanced. But secondly, this leads to the market consolidation of big companies who have access to the best technologies because they can devalue the stocks of their competitors, and therefore this makes it easier to buy them up. True, I would like to concede that big companies have an incentive to do this anyway, but top half concedes that in the short term, this AI will be more efficient. I agree with OO that in the long term, this AI will be less efficient, but insofar as in the short term, you are more efficient at predicting market trends, it's easier for market consolidation to happen for big companies. Thirdly, this makes overt market manipulation a lot easier. If you want to undergo scams like shorts, by which you bet that another company's stocks will go down and earn money, or if you want to artificially inflate the value of your own stock, now you have more of a capacity to do this in the short term. What are the consequences of this? First of all, this generates stock increases that do not have any real value in the economy. If your company artificially grows but does not give any real value to people, then this is money that is wasted. Secondly, it can harm small companies who can compete with with big companies in the counterfactual, and therefore drive down the prices for the consumer insofar as they have an incentive to lower the prices so that the people buy their product. But thirdly, this makes it easier to intentionally cause bubbles if those bubbles will make you cause or earn a profit. Let me weigh this against opening opposition, because opening opposition says that bubbles will naturally happen with this technology being in place. Sure, they might, but I think OG somewhat mitigates this by saying that probably there will be some safeguards over time, or that companies have an incentive to do this wisely so that it doesn't happen too often. But note, insofar as we prove that big companies can do this intentionally, if they have total control over their own AI model and no one else can stop them, they can deliberately cause this harm. So I think that our analysis of risk is simply stronger than that of opening opposition. So we prove more risk and less power for the small investor. I think this already takes down opening government. But let's move on to our second extension. Opening government says that investors often invest based on emotions and based on the human element of how valuable you consider a certain company to be. This is actually a good thing. I will prove why we will have more speculative investment on side opposition when it comes to small companies, and why this leads to more innovation. What is the first reason why we'll have less speculative investment and venture capital inside government? Because for the reasons that OG gives you themselves, that this is perceived as more objective by investors, which means that if someone within your company or within a group of investors in a hedge fund wants to invest something that might or might not work, they will tell you, oh, the algorithm says this will fail, which means you'll have less of an investment. In the counterfactual, here is how people invest emotionally. Firstly, they might believe in a certain social project because it aligns with their values. For instance, investing in Black businesses because you, as an investor, care about these businesses becoming bigger and bigger. OG says, oh, there are like biases that exist within humans. Sure, but these biases are going to be consolidated by the AI Whereas on the counterfactual, younger people and newer investors are more likely to be more progressive than older investors. But thirdly, and this is most important, discourse becomes more visionary on our side of the house because you do not speculate about what works, you speculate about what you can do with this technology. You imagine if this new venture capital project can fix humanity in some important ways. Know that we can see that we will have more failed small venture capital businesses that do nothing. But the counterfactual, guys, is that McDonald's just get more money. Pfizer gets more money because the algorithms will predict that the big companies are the safest. It's most safe to invest in the big companies. So you have just more money being pumped into companies that do the same thing and do not generate any new value for society. Before I impact this, I'll take a POI from OG.
Yeah, I told you in my speech that the brokerages like Goldman, Fidelity, or Robinhood, massive companies, integrate also the really good AI into that, but also poor people can just buy funds that use the AI. Without proliferation, only the big companies have it on your side.
Here's why you can't do this. Here's why. Okay, I interrupted you. Here's why AI cannot predict if like a small company will become successful in the long run. And here's an important piece of characterization. Most venture capital companies are not profitable for a long time. Uber took 8 years to become profitable. It was in a deficit for 8 years because it first had to drive down the prices, but then later on it became profitable when it achieved market consolidation. Uber is a useful invention because it's now much easier to travel than it was with other taxi services that were less efficient, which means that if we now have a more speculative investment, we have more innovation. Why is innovation good? Innovation is good because even if 1 out of 10 small companies are a success, they can significantly improve people's quality of life. For example, if you have a drug that has fewer side effects, then if you're a depressed person and take that drugs, you're unlikely to get a bad symptom and stuff like that. So we actually improve the quality of lives of people. But secondly, we give more money to small businesses because on their side of the house, more money is given to big companies like McDonald's and like Pfizer's, who are already quite rich. On our side of the house, you give money to people who are otherwise structurally locked out of opportunities because they do not have a high enough credit score and stuff like that, which allows them to become economically emancipated uniquely on site CEO. That's why we win this debate.
I thank the member of opposition for that fine speech and now invite the government whip here.
Hi, can I check that I'm visible and audible?
Yes.
Okay, great. I'll take POIs in the chat. Starting in 3, 2, 1. The debate has to be about the worker ants of the financial trading world. They are the ones that influence market trends. The public interest that determines the initial public offerings for the IPOs before new corporations are listed is based on public demand and based on what individual consumers in the market want. The consumers are the people behind products and services and the trends that arise and the corporate relevance of structures to invest in and where we issue and where we put equity. That is why the opening half had to lose this debate, insofar as the opening half largely focused on the large consumer decisions, the large decisions that private equity firms, hedge funds, etc., and large economists are going to be making. Insofar as in CG and member, we already framed out why those were the most important stakeholders. Insofar as even if we were to agree the best case from opening government, that it is the case that there's more information and there is more information synthesized that the average human cannot, we think that there is marginal utility to the individuals at the top, to the hedge funds and the brokers that already had access to manipulating, as CEO would say, manipulating, accessing, and interpreting this data in their for their benefit. The only thing that we really hear in terms of the individual consumer from OG, which is what CG differentiates very clearly, is that outside of just saying that, oh, people make potentially bad decisions, and note that there is no impacting or analysis as to why this is impactful in this round, outside just that the individualistic harm, insofar as people don't make bad decisions. What CG does is that we uniquely position why the individual is the kingpin in the economy, insofar as it accumulates into large economic decisions and economic stability. The 2008 financial crisis being led by individuals believing that mortgages were beneficial, were a safe equity and a safe investment are things that we uniquely avoid on closing government. That is the accumulation of individual decisions outside of just just whether or not they lose a few dollars because they made the wrong decision. Closing government does not care about your few decisions that you make. We care about the risk that you're going to be undertaking and the economy in hand. How do we deal with closing opposition? In a few ways. On their first extension about how there's going to be an increasing gap between big and small investors. The idea that individuals or larger corporations are going to always come out, given the algorithm model will predict they're safer, literally is a non-argument, because it's just general knowledge in trade that when you're going to be investing in established firms, for example, buying stock in Apple, it is always going to be far more stable than investing and buying stock from a newly listed firm or from a startup company where the potential is insurmountable or you're unable to necessarily quantify. Note that on our side, we contested whether or not this AI model required the advancement that both OO and CO wanted to contest. CO says that the AI model is more advanced than others, which means a discrepancy in competition within the market. We think as competition rises and the kinds of corporate structures you're competing with. So for example, at the top, I think there's equal resources for the AI models to be implemented. Similarly, on an SME levels, I think similar SMEs with the same capacity to engage in AI models that are symmetric on either side. But the idea that from OO, that there's limited data and limited patterns, we don't think necessarily matters, given that we care about the individual consumer and what are the patterns that matter to them, whether or not I don't think the kinds of patterns and trends of $1 million investments is what CG is hinging their case on. So the challenges is with the efficacy and the advancement of this AI is null in this debate from closing government. But then the idea that there's going to be less innovation, I think this doesn't make sense in this debate for a simple reason. Because I think the average individual, the people that make these decisions, aren't the ones that are funding startups and innovative SMEs. These are probably the hedge funds and the individuals with large pockets and equity to invest in them. Closing opposition's burden, therefore, was to tell why these individuals would opt out because of the AI modeling that is going to be there. Note that given startups likely are unquantifiable in terms of data. That is to say, the AI can't account for something new if we are going to buy the analysis that you can't evolve, and that these are things that are often, for example, services and products, which means that it's uncertain how an individual consumer is going to respond to something new that is likely unquantifiable, in which case the human aspect of self-evaluation that corporate structures or venture capitalists are going to use will then apply symmetrically. So these individuals will likely just assess based on humanistic characteristics whether or not they think this product has potential within the market to reach consumers and then therefore invest. Therefore, the idea about innovation is gone from closing opposition. Before I move on to extending opening.
Yeah, I want to make it really clear. Retail investors get fucked over on either side, killing CG, and AI data collation happens on either side, which symmetrizes a lot. So when we prove that brokers are increasingly unbiased, accountable, and experienced in making decisions about trades, it means you can't just respond by saying human biases as though it's a debate about babies.
No, closing government does not care about the financial decisions and whether or not you make money from this. It is about the accumulation of your decisions and whether or not it creates risk. Note that our case was simple, that we wanted individuals to be far less risky in the financial decisions that they make. The logical extension of this is how the AI is likely going to be built on risk-averse mechanisms and risk-averse algorithms. Given its just simple characterization that losing money is largely unpopular and individuals would not want to opt into it, for example, high-frequency trading, eToro, etc., that make it accessible in the first place. If you're going to be constantly losing money, it's easier to secure individuals on the idea of safety as opposed to the one in a million person that is going to make a lot of money off these apps. Note that therefore the ability to combat these kinds of biases is necessarily important, and this is what we extend. We fully agree with OG in terms of the natural positive biases that you have when in terms of making predictions, etc. We said the simple thing and the extent of this here is that people don't like losing money, and when the risk is too high, most people are averse. The question then becomes who tells these individuals and gives them the information to make these choices on their own. Insofar as there are positive biases, you are unable to recognize the risk associated with certain assets and associated with certain equity. Often the positive biases then overcome the risk as opposed to a third-party AI that is telling you objectively this is a bad decision or you should not put a lot of money in this decision altogether. Insofar as we solve imperfect information to the greatest extent on CG, we provide and we prevent the large-scale harms that occur to the economy in terms of its stability. Note that it's simple. Insofar as more individuals on our side make risk-averse decisions, don't invest in equity, don't invest in mortgages, for example, based on state propaganda, based on outside factors as opposed to profitability and whether or not this is an objectively good decision for you to make, the accumulation of these bad decisions don't destabilize the markets. Individuals were unlikely on our side, if this was a thing that proliferated in the past, to have accumulated to the 2008 financial crisis, where individuals constantly bought up mortgages because the idea of owning a home was something that's proliferated throughout society and pushed pushed to them as a good and safe investment. On our side, the AI is unbiased. For these kinds of decisions, those were crucial for the economy. For these kinds of decisions, it was make or break for whether or not economic stability, and therefore the extension of that, everyone in the nation, if not globally, was necessarily effective. Only on CG do you correct for that imperfect mechanism. Only on CG do you explain why the individualistic impact has to far outweigh large hedge funds, venture capitalists, but aside from just the individualistic harm, why the individual is important, given that the individual is the economy.
Great. I thank the government whip and now invite the opposition whip. Here.
Can you hear me?
Yep.
Okay. I'll be starting by explaining to you why do we win bench and why we extend over the opening opposition. So opening opposition case largely is asset bubbles are going to happen. The problem with this case is that their case, as per their own analysis, is beaten by their own rebuttal, because if there is an incentive already to avoid the bubbles, if historically they have happened a lot, and you have an incentive to avoid them and not to do them anymore, presumably as per their own analysis, there is an incentive to teach AI about the bubbles and to teach AI how to recognize the bubbles and stuff like this. This is not a knife. I'm just showing you they're on comparative, right? So you have an incentive, like then you can like teach it, about the bubbles and all these sorts of things, which means that in that moment, artificial intelligence is able to recognize that the value of an asset is inflated, not because of its actual value, but because of the artificial demand, and it's probably not going to make that trade, right? If it is trained by the previous data and stuff like this, and this has historically happened, then I presume that their case is uncomparative. So that's the main issue with the opening opposition. But Robbie solves this by explaining to you that the key mechanism here and why unfair advantage is going to happen and why unfair trades are going to essentially happen is because there are institutions that have these incentives to inflate their value and all these to inflate value of their assets, of their stocks, and all these sorts of things, which means that they are going to be able to feed artificial intelligence with a biased research and biased data that is going to, make these trades that are going to, make these trades that are going to be beneficial for them. Now, how is this possible? I have two mechanisms here. And this is also something is largely responding to the opening entire government bench, basically, because entirety of government bench was just trying to prove that this is going to function well, right? But insofar as they're unable to prove this, they can't win this debate. So why is it possible to feed it with biased data and stuff like this? Firstly, economy isn't exact science. It's not like math or chemistry where something necessarily has to lead to a certain conclusion, right? You have different schools of thoughts, different theories, and all these sorts of things that cannot usually coexist together. And very often, even when you are making safe investment, something that is completely calculated and stuff like this, it can turn out to not be profitable and all these sorts of things, right? So it's not an exact science. But secondly, that means that you essentially have biased research. But secondly, rich capitalists are the ones that were able to historically fund the research and all these sorts of things, which means that you are able to justify any kind of theory in the economy, and you are able to find any kind of research or information to justify to the artificial intelligence why it should make a certain trade. We then believe that this is something that is bad, because then we are able to prove better than the opening opposition why essentially you're going to have a power asymmetry of these stronger actors who are then going to be able to cause market disruptions and all these sorts of things. Secondly, I want to talk about closing government. So what closing government essentially does is, firstly, they say that artificial intelligence is able to predict errors in the ways that human can't. That's not true. Artificial intelligence is not superior to humans. It's just it works faster and stuff like this, and it probably doesn't have this human element, but it's not, in terms of knowledge, it's not superior to humans who literally created the information to feed AI with this knowledge that it uses. So I don't think it's this magic robot that is going to be able to predict prices before humans are able to. Secondly, they're talking about individual traders. I have multiple responses to this. Firstly, this as per OG's framing is out of the debate, because if opening government says that this debate is only about funds and not about individual traders, I do not understand the point of this extension. But the most obvious response to this is that not a lot of people are like trading stocks who are like completely incompetent, right? Like there was an entire GameStop fiasco, and then people got very scared and realized that, you know what, I would rather keep my extra $100 than to like invest in the stock market and stuff like this, and like all these sorts of things. So I don't believe that this is a large impact necessarily. But secondly, I would like to flip this and to say that like even if this is true and that is, you know, majority of this debate, I don't think that it's actually good that people who don't have a lot of money and people who are not that into economy are doing like investing the little money they have into stocks, because like even if closing government is able to prove that this is going to lead to like better investment than it would have if they do it on their own, it can still be a bad investment, right? Like that's the thing with the stock market. You can like try to calculate and predict all these sorts of things, but it can still end up being a bad investment. So I don't think that it's good for people to make this like automated decisions without thinking and, you know, blindly trusting this AI, and they're losing their, you know, money. Like it's better to just like keep money. You're probably not going to make yourself super rich off of it, so it's not a large impact. Then to respond to our case, they say that big funds have an advantage. Either way, but like insofar as in short term they are more efficient, which is something that the top half talks about. This means that rich companies are able to devalue small companies, as Robbie explains in his extension. But I think secondly, when they're talking about risky companies and they say that like they're either way not going to get investment, this is why the human element is important, because insofar as vast majority of this trade is done by proliferation of artificial intelligence, then when these like risky companies are entering the market that may actually be profitable in the future and stuff like this, for example, like Uber was, then what is essentially going to happen is that you're going to get less investments. But it's also problematic. Okay, I'll actually take OG.
If your extension is that traders want to exploit AI to crash the economy and pop bubbles, Tanay and your own member says AIs interact with each other. So they see that a scheme is happening, raise alarm bells, and don't invest. But without proliferation, big funds still do the scheme you're talking about, but there's no accountability mechanism because you have no way that they're trying to do the scheme.
So I think that when it comes to accountability, it's actually worse on your side of the house, because then you're able to like pinpoint at people. You can't really blame the robot for the things that happen. But I think also secondly, it's not that like, sure, like they may be like interacting with each other, but like obviously like the dominant AIs that are going to be used in the majority of cases are going to be by these rich actors. And yeah, I also think that it's important to like understand that sometimes companies can fluke when they have to make like big investment into something or something else, and this is why they're not going to be incentivized to do these sort of things. Regarding opening government, I think OO points this out already, but like their entire benefits are just about, we have to, AI is good. Yes, we can use it on our side of the house as well to help us, but it's bad when the final trade is made by the AI. And the reason for this is that AI is prone to hallucinations because of the training data quality, which Robbie essentially proves to you. So in order for that rebuttal for all to work, you need Robbie's extension, and because of the generative method that AI is using, and for all of these reasons, vote for us.
Great. I thank the officers for that fine speech and everyone for a good debate. You guys can leave the Zoom now, and I think the call will be announced on Discord. Also, could we stop the recording?